So hi everyone, it's Wisdom Jordan right back again here, and in this video I want to start up a new series called creating your own trading strategy. Okay, and before you go any further, I want to request you one thing. If you've not yet subscribed to the channel, please do subscribe, and then you also make sure that you like the videos that you watch in case you like them. And then so you also make sure that you do some shares so that you can support my work. And then I'll also be motivated to keep more and more more trading videos. Okay, so in this series we're going to be looking at creating your own trading strategy, because over time I've found people looking out for trading strategies in the forex market, and they just bump onto a forex trading strategy they find on the internet or on YouTube, or they find someone who calls themselves the pros. They give them a strategy, they go out and try it, and then they face big financial losses and they get frustrated within the market. So uh, there is this simple way of which you are going to be following in order to find out how we can create our own trading strategies that we shall be using. So number one, we are going to be looking at what we call the baseline. Then we shall be looking at the primary indicator. Then we should be looking at the secondary indicator, the volume indicator, the exit indicators, and the ATR indicator, and then the common knowledge that I've been showing you on the YouTube channel. So I've already covered candlestick patterns, already covered chart patterns, I've already covered trends. I've not yet covered news, but we shall be covering them later, and then some few other videos. Okay, so in this video we are going to be starting up with a baseline, and then we get to know within the series of creating our own strategies, we're going to be shooting up with number one. Okay, so let's dive in. So the baseline, and this is your guide to winning or losing within the market, because it is the number one indicator you're going to put onto your chart. So it's a number one indicator you're going to choose when you're putting or creating your trading style, or what we call the algorithm. Okay, so the baseline. Okay, so a baseline is an indicator that is only on charts. Okay, so we're saying that every time you go onto a forex chart, you'll find that it has two windows. Okay, it has what we call the chart window. Right down here, it has a chart window, and then the indicator window right down here, and then right up here it has the chart window. So this is what we call the chart window. That is where the baseline is supposed to be. Okay, so the baseline has three purposes, and then number one, it is to signal which direction you should be trading. So the baseline is always there to guide you. Are you going to buy or you're going to sell? So that's the direction. If you choose to buy, of course the direction is a bullish direction, and then if you choose to sell, your direction is a bearish direction. Okay, if the price crosses or closes above the baseline, you are to trade long, or that is what we call the bullish. Okay, if the price closes or crosses below the baseline, you are to trade short or you are to trade bearish. Okay, so for example, if we have this, maybe the 10 moving average as our baseline, and then the price comes and then closes above, like it closes around here we are looking to buy. And if the price comes and then it closes below this baseline, we are looking to sell. As simple as that. Okay, so another purpose for the baseline is to signal when to exit a trade. So for example, if this is your baseline, okay, and then the price comes to then it closes here, okay, yes, we are going to buy. But again, if the price comes and closes below the baseline before your target has been reached, it means that you have to exit a trade, because the direction according to your baseline has changed. Okay, so a baseline can be used to signal an exit. Okay, and if price crosses or closes above or below the baseline in the opposite direction, you are in a trade, you have to exit. So we are saying if this is our baseline, okay, and then the price, so for example, when you look at, maybe we expect the price to go high, okay, and then the baseline comes and then the price closes above the baseline, so we are looking to buy. Okay, and then the following day you get a big retracement and the price closes below the baseline. Here you have to exit the trade and then look for a new signal. Okay, uh so it signals if you are entering a trade at the best price. Okay, to enter into a trade, of all your indicators must be given, must be giving a signal, but price might also be within the 1 ATR zone before you can enter a trade. So we are saying that, for example, if this is our chart, if this is our chart, and let me try to change the color a bit, and then right here we have our baseline. So we are saying that when the price comes and then it closes, for example, this is our chart, and the price comes and closes above the baseline right there, it means that this price is supposed to be within the 1 ATR range, and we are going to be looking at this on the live chart. So it's supposed to be within the 1 ATR range. So for example, the price comes and closes right far from the baseline, it means we shall not enter that signal. So if this is the baseline and then the price closes right far up there, so this distance where the price has closed to the baseline is supposed to be at most 1 ATR. And if the price is far more than 1 ATR, we do not enter because the price is not good. Okay, that is what we mean. So if the price goes outside the zone, the price is too far gone and you are overpaying for it. So that is simple. So if this is your baseline, okay, and then you want to for example, we are going to make a short trade from here, and then the price comes and it closes here, but the distance from the baseline to the closing price is supposed to be at least 1 ATR. So if you've not watched a video about the ATR, please go and watch the ATR indicator so that you get to know what you're talking about. So that is 1 ATR. But if the price closes, it comes far from here and then it closes right here, and this is more than 1 ATR, we do not take that trade, because if we buy from here, we are overpaying for the price that the market has given to us. Okay. So for our baseline to be good for trading, make sure it provides at least 70% win rate in every 10 trades, or the 10 trade signals your baseline gives. So we are saying that 7 must be winning trades. So we are saying that if you have a baseline and then you go for back testing, you have to make sure that in every 10 trades you make, you make at least 7 wins. So when you make 7 win and then you make a 3 as a loss, it means that you're going to be having a win rate of 70% and a lose rate of 30%. So you remain profitable. So a good baseline will always give you at least 70% win rate within every 10 trades that you are going to put on a given pair. So a good baseline will be well back tested in a choppy market. So there is a time when the market is moving this sequence, okay, and then there's a time when the market is smooth, okay, is on a clear uptrend, or the market is on a clear downtrend. Okay, so when the price is choppy, that is when it is the best time to test your baseline, because within the consolidation markets, when you're creating your trading algorithm, because in this algorithm we are going to be following the trend. So we are trading the trend, so we have to make sure that we get the big moves of the trend, and then we have to avoid this choppy market or the consolidations. Okay, so a good baseline is always tested so that it can be able to avoid some consolidations, or it has to make sure that within a consolidation, if it is to give you 7 losing trades with another baseline here, it will give you like 2 losing trades. And then you also don't forget that we also make money by not losing. Okay, so a good baseline is always tested well within this choppy market. Okay, so if you have a baseline which is passing through this choppy market, you have to make sure that the baseline at least avoids some of the signals, or it gives you at least fewer signals within that consolidation market. So different pairs may need different baselines. So for example, we are not going to use the same baseline for trading Euro USD and maybe the Aussie dollar, because these two pairs are going to be maybe moving in a different directions. So they move differently. They are pairs which are always smooth, they pick a trend, but they are pairs which move once, then consolidate, and then move, okay, and then they consolidate, and then they drop, then they go back again, and then that is how they move for them. But they are pairs which are always choppy in most cases. So different pairs might need to be used on with different baselines. So a single baseline may not work on the entire market. So that is of course logic and very clear that you cannot get one hook to fish all the fish within a lake. So that is simple. So you have to make sure that at least you get more than one baseline you're going to be using on different pairs you're going to trade. So you can find that one baseline will work well maybe on 10 pairs, and then you find another that works well on 5 pairs. Okay, the baseline which works best on a given pair is what you put on that pair. So don't forget the target is to provide at least a 70% win rate. Okay, so right now we are going to jump onto a live chart and then to try figure out what the baseline is and how the baseline is used. Okay. So we are right back onto a live chart, like we've said, and then we want to check out what the baseline is. So we don't need any other indicators. All we need is to see what the baseline is. So we say the baseline is an indicator within or on a chart. Okay, so for example, if we try to put on a indicator, so you have to go to the indicator panel. Here, then you can say maybe a trend indicator. Then you have to put on a moving average. Let me say the 20 moving average. Okay, I don't know if it is very clear. Let me try to make it more bold. Sharp. Okay, and then maybe if we try to put on another indicator. So when you look at the chart, of course, we have two sides of the chart. So we have this chart side and then you have the indicator side. Okay, right here, this is what the indicator side is and this is the chart side. So the baseline is always on the chart side, okay? So the baseline is always on the chart side. That's what you have to note about the baseline, okay? So when you look on this chart, of course, you can see that this is Euro USD as a currency pair. And then here we have the bid and the ask prices of the sell price, and then you have the buy price. Here you're seeing that you have a lot size of 0.02. This is Euro. And then this is a daily chart. So every candle you're seeing on your screen, it's taken 1 day to be formed or 24 hours to be completely formed. Okay. So right here you can see that the chart is also on a clear uptrend, and then here there was a retracement, and then there was also a new uptrend to be formed. Okay, that's a basic recognition what you're seeing on the chart. But right now I want to clear everything so that we have a plain chart. So the purpose of a baseline is to pick a trend. Okay, so in this trading algorithm, I want you to know that you are going to be looking for the trend. Okay, so we want to look for something that avoids this but still gives us this. So you make sure that within when you're trading, if you want to make money, you have to note that one thing, that if the price is moving, it will not move in a straight line. But when the price is moving, it's going to move high, then retraces, goes high, then retraces, then goes high, maybe tries to consolidate, and then maybe keeps on going high, then consolidates like that, like that, like that. Maybe it then changes direction. That's how the price is going to be moving on any given currency pair. So what happens is that when you are going to trade within a trend, you want to pick up these portions and then you want to avoid these retracements, especially for those who are within the market for a short time. You want to pick up this. You want to pick up these general moves that form a trend. Okay, so a trend is always made up of swing high, swing low, swing high, maybe consolidation. Okay, and then maybe a continuation within a major trend, and then a retracement, swing high, then maybe another consolidation, maybe a bear market, and then maybe a new move high, swing low, move high, like that. That's how the market moves. The market will never give you something straight. So if you come and then you turn on a line chart, for example, when you look at the line chart, this is exactly what I'm talking about. So you only make money when the price is moving in this format. This is where you make your money. Okay, here. That is where you make money. That is the target of what you're targeting in every trading session. Okay. So for every trading session, you are targeting this. Okay. You are targeting these big moves here. And then you want to avoid these retracements. Okay. That is what we are targeting. Or sometimes you can bear these minor retracements. For example, here there's a minor retracement. Okay. You can bear them. You can maybe buy from here and then exit from here, but you have ignored this retracement. Okay. So what we are going to target is that we need something that is going to help us to pick this. So if this is how the price has moved, what we are purposely looking for is something that is going to show us that we are going to buy from here and then we shall exit from here. We are going to buy from here and then we exit from here. We are going to buy from here and then exit from here. We are going to buy from here and then exit from here. So someone is asking, why aren't we looking at these sell trades? Counter, we call them counter trade, counter trades, okay? Or you call them the counter trend trades. So these counter trades are not going to be done because we are following the major trend. Okay, we do not want to lose money. Okay, and then so we are looking for a baseline which is going to show us that we are going to buy from here and then exit from there. Okay, so let's go back to our candlestick charts. Use a candlestick. It doesn't matter the time frame. It depends on time frame you will want. So if you want daily candles, you don't have so much time to sit on a computer. Of course, you can now sit on. You can choose the higher time frame. So someone can say, "I'll use the weekly time frame," or another person will say, "I'll use the H4 time frame." Another person will say, "I'll use the minute 15 time frame." It is all good. So you have to just go back and watch a video called "What's the best time frame to trade?" Okay, let us go back to our daily candles. So on a chart, as you can see, we are looking for something that is going to tell us that we are going to buy from here and maybe try to exit from here. And then that something is supposed to tell us we're going to buy from here and look for a new exit. And then you want to look for something that is going to help us to ignore this short trend. Okay. So we can go back to the history a little bit. We go back. Still the same thing. We are looking for that small line which is going to tell us to buy from here and then maybe exit from here, because this is where you're making money by selling. Okay, because you sold from here and then you exited from there. That is what we are looking for. So what can we use to make sure that as the price is going up here, we are not in, but when the price is dropping here, we are in, and then by the time the price is going to come back to form that, we are out. That's what you're looking for. So right now, I want to start up with maybe moving averages as baselines. And the number one thing we are going to try using. So we shall come to indicators, then we trend, then moving average. So we can try this 20 moving average, and you can leave it to exponential, or you can choose to put it at simple, and then you click OK. So when you look on your chart, okay, we are saying that as we said that every time the price closes above the baseline, when the price comes and closes above the baseline, we are looking to buy. And when the price closes below the baseline, we are looking to sell. Okay. So it means that according to the current chart, we are supposed to sell from here, and this is a loss. Okay, because the price did not go that further. And then when the price closes above, this is a buy, and this was a winning trade. So when the price closes below here, this was a sell, and that was a loss. And when the price closes right above here, we are supposed to buy, and then that is new income. Okay, so you can see that from the current trade, and then from here we also bought, and maybe that was a short-term win. Then maybe from here it was loss, and maybe from here it was a win. So you can see that this 20-day moving average is already giving us 1, 2, 3, then 4 wins, and then it is also giving us something like 4 wins and then 2 losses. So that is how the baseline works. Okay, so the baseline is purposely supposed to be placed on your chart so that it tells you the direction you should be going in. So we are looking for something that is telling us that, hey, when you cross above this line, we are going to buy, and when you cross below this line, we are going to sell. And then we say that the baseline is well tested within a choppy market. So for example, you can see that right here we had a short-term consolidation. Okay, and then according to our baseline, it has given us so many signals. So that means that the 20-day moving average at a simple setting, it means that it was not a good baseline. So you can look here and then see that you had so many losing trades. Okay, and we are saying that every time the price closes below the baseline, you sell. The price closes above the baseline, of course you look to buy, but this was not successful. Okay, so you have to go back and backtest, and that is how you backtest. So you simply go back to history. Okay, then F12 is candle by candle move. So you can see that now that is a buy. Okay, so it means that you are going, in most cases, it is better to use what we call the limit orders, because sometimes you can see that the price is here and then it opens from here and then drops back and then you don't get triggered. So you can go back and watch that video about types of orders. So sorry, we are there. So we are in. We have made a buy order. So we go to F12 to press candle by candle. So you can see that the price triggered you, but then the price has reversed. So when the price closes below the baseline, we say that we exit a trade and close in a loss. But you can see the price has not closed below the baseline. So you go to F12. Okay. Sorry. So we write here buy, price comes back, and then that is a loss. Okay, so we are looking to sell from there. If you go short, you can see that now the price still hits but doesn't move that much, and that is a loss. So again, like that, like that. So when the price closes above the baseline, we say that if you are looking at a major trade, for example here, if you bought and then the price comes and closes below the baseline, you have to exit that trade. You don't wait for it to reverse again like that. No, you just exit there and then. So this baseline, this is a 20-day moving average. You can see it has not worked for us so well. So what we can do, we can try to use another baseline and then see if it will work well compared to this one. You can see that right here, it gave us so many right here. It gave us so many trades and then we cannot use it. So here you have so many losing trades and then we say that you make money also by not making losses. Okay. So let us try using another baseline. So for example, this moving average, we can change it to exponential and see if we get better results. Okay. So you can see that we get the same results. It does not exclude these consolidations. And we say that a good baseline will help you to always exclude these market swings and then it captures this big move. Okay. So we can try to use a different baseline. So maybe we use, let me say 50 moving average, or we can use even 100, and you feel comfortable with 100 exponential. You click OK. You can see that right here, the baseline is saying that you are selling from here and then you are exiting from here. That's a good baseline because it has excluded these market consolidations. So when you apply an exit indicator, which we shall look at in the later video, you can see that you entered from here and maybe the exit indicator said exit. Hey, we are continuing, and then you continue. And then hey, here we're not trading, but here we are continuing, and then you continue. Okay, so you can see that this is now a good baseline because it has excluded these major consolidations. And then from here, yes, it made a loss, but recovered them by giving us. So if you're using moving averages as baselines, you can see that the higher the moving average and that big, like the better it becomes. Okay, so if we zoom out, we can try to figure out that a good baseline will also give us fewer trades. Okay, so if you try to zoom out, you can see that this is a very good baseline. Why? Because within an entire period of like a year, it has given us only one signal to sell. So here there was short term, but maybe with other indicators it would be excluded. So this 100 moving average is a good baseline because here you bought and then you're still within the market. Then you can see that from here, this was a sell order, okay? And then you had to exit from here. It's a very good baseline. So the higher the moving average, um, the moving average setting, the better it becomes as a baseline. So let us try to zoom in a little bit, Shift plus. So you can see that as we move backwards, that this moving average gives us, it helps us to exclude what we call the market reflexes or the markets where the market rests. For example, right here, this retracement was not given as a signal. So for example, this short-term consolidation, and then here we have another one right here, or maybe this big, this short-term bad news, and then the price reverses. So you can see that even right here, it gave us fewer trades compared to another moving average. So let us try to add in another moving average which is having a shorter frame. So for example, here you can come and say insert indicators. You have the trend indicator. Then you go to trend. Let's moving average, parameters. This is an moving average. Come to trend, moving average. This is 100. Maybe we try to put in a shorter moving average like that of, let me say 40. And maybe let us try to use simple instead of exponential. Okay, simple, then you click. Okay, let's try to change its color to maybe red. So we can see that the blue line we are seeing on the screen is the 100 exponential moving average, and then the red line is the 40 simple moving average. So you can see that which one is giving us more is giving us more signals that are false. That is what we have to ignore. So you can see that from the general view from the chart, you can see that yes, this one gave us a first signal right here. Okay, they both gave us a signal to sell, but you can see that this blue line, which is the 100, okay, has given us one signal all the way within the entire chart. But you can see that this red line has given us a signal right here to buy. It has also given us a signal right here to buy, another signal right here to sell, another signal right here to buy. So if you try to count losing trades, here it has, this blue line has one winning trade, but this red line has one winning trade. You can see that this is now a losing trade. It was not successful. You can see that right here you have a losing trade. It was not successful. Here you have a losing trade. It was not successful. Here you have a losing trade. Right here you have another losing trade. Okay. And then maybe right here you also have another losing trade because the moving average is a shorter frame. Okay. So you can see from the total view it has one win and then it has 1, 2, 3, 4, 5, and then 6 losses. So that is a total of -5, -5. Okay, but this one is already having one trade out of one. So this one is having it was having how many? 5 losing trades and then one winning trade. That is 5 losing trades out of the 6 it has given us. 5 are lose and then 1 is a +1. So this is something like 95% loss. Okay, and that's why we say that traders who lose money are always in 90s. So you can see that that is how people lose money, but they never get to know that. And then you have this one which has given you only one single signal, but this is 1 out of 1. So 1 out of 1 times 100, that is 100%. So you can see that this baseline, which is higher, it has given us a better time frame. Sorry, it has given us a better way to trade. Okay, so this is 100, this is the 100, and then this is the 40. So if you try to put in another baseline of, let me say, 200, you'll see that 200 will end up performing better than 100. But I also want you to know that a baseline is not supposed to be so slow, and then it is not supposed to be so quick. So if it has to enter you to give you a trade at the right time, and then it has to exit you at that exact time. So for example, here it's supposed to say we are buying from here and then exit from here. We are buying from here and then exit from here, like explain. So let us try to add on another baseline. We can try to use the Kijun soon, and that is from the Ikochumo as an indicator. Or okay, we can try to use another. Here we have this one Ikochumo Y. Then we are using this one as a baseline. This Kijun send the baseline right here. This is what you're going to try to use as a baseline. So you can leave it at 45. Okay. So colors, okay, that one is none, and then click OK. So this aqua line, let me try to bolden it, or we can try to exit these ones that we have set already. So you can see that this trade, this baseline, will it give us few trades, and will it exclude others, other market reflexes? For example, it didn't exclude that. It didn't exclude that. Didn't exclude this. It then that is, so that means that this one is better than the previous indicator, which was 40 simple moving average. So you can see that you just go on back testing different baselines, and then you'll be able to see which one works better. And then you also try to maneuver this setting. For example, here it is set at 45, but if we try to maybe say, let me take it to, let me say 59 as a digit, and then you click OK, you can see that it tries to figure out that this one I will ignore it. So if we move it to around 100 or 80, or we can say 90, you can see that now it tries to, last time it gave us almost 3 losing trades within this chart, but right now it is giving us only one losing trade. So you go on altering your settings, and then you find out what will work based on that given currency pair. So that's how the baseline works. Okay, so let us try to look for maybe, let's go into the history and see. You can see that here it worked very well at the baseline. It gave us the direction of buying, and then it ignored these reflexes. Okay, these reflexes, and then it is also giving us beautiful signals right here to sell. Okay, so you can see that right here it has ignored this bad consolidation, though on this consolidation it did not exclude them. So it is not a holy grail trading method. Okay, it's not a holy grail trading method. That's what I want you to know. So we can look here and see that almost the entire year, or like 3 or 5 consecutive months, it has given us. From here to here, we are selling. You can, everyone can see that very clearly, that the baseline has given us only one entire signal within, that is from May up to up to May. That is almost another year. Okay, within 1 year you have one single trade. And that one single trade has solved a lot of things psychologically. You're not always on chart, so just monitoring to see how money is flowing in. So that's how we are going to be trading. Instead of seeing on charts all the time, you can be using these baselines which are long, so that you pick one signal that is major. Okay, so here you made some losses and some small wins. And see that this baseline tries to figure out that, oh, these bad market reflexes, I will not pick them. So for example here, gave us a signal to sell, which was not successful. But again, when it gave us a buy signal, it ended the signal always from, that is September, between September and March. That is almost 1, 2, 3, 4, 5. Those are 6 months of one single trade. So within 6 months, you have made only one trade. But if you go to another type of trader who does not use this method, you can find out that within these 6 months, a trader is having almost 2,000 trades and is not making money. But you've made only one trade and you are making money. Yeah, the idea of forex trading is simple: make money. Doesn't matter how you make the money, but the idea is only simple: make money. Okay, and then there is the other way of making money, the better. So you can see, we can try some other indicators. We can try, and let me say this one. This one needs internet, and I don't have internet. So custom to adaptive moving average. Okay, so you can see that this one is so smooth on a chart. Let me try to zoom in. You can see that this one is always on the chart for time. Try. So you can see that if you have this baseline, this is colors. Let me try to present the width. Okay. Okay. So every time the price is moving downwards, it will change color to orange, and when the price is moving high, it will change the color to green or aqua. Okay, depending on what you're seeing. So you can see that this baseline is surfing the price. Okay, so a good baseline will not always surf the price. You can see that right here it is now crossing through the indicators. So that is not a good baseline. So, but in most cases, a good baseline will always hover below the what? The candles, like this. Okay, like this. That's how a good baseline will move. So a good baseline will not always move like this one. Yes, here it moved well, but it is overcrossing the prices like here. Just check. That is not a good baseline. So you have to avoid such baselines. Okay. Let me delete this. Hi. So we can try another one. Last one is the last one. Uh, Alma Pigeon. So we can try this one and see. Plus, okay. Let me see if you have a baseline here. So you can look here that now here you have another baseline. So this line, the dotted line, is the baseline we are talking about. This one here. So when you look at it, you can see that it tries to figure out, but right here, it gives us so many market reflexes, and then we cannot use such a baseline. So the other thing I wanted to look at was the ATR zone when the price crosses above the baseline. Okay. So for example, um, right here, F12, you can see that now the price is above the baseline. So this is a signal for us to buy. Up here, this is a signal for us to buy, but we say that the price is supposed to be within the 1 ATR zone. So 1 ATR zone means that the closing price, the price at which the price closed to the baseline, when you measure that distance, it is supposed to be 1 ATR at most, one of the ATR. Okay, one of the ATR. Okay, so for example, there's a different type of ATR I'm using. So for example, when you click here, you can see that ATR stop loss is 109, sorry, it is 260 pips. Leave alone the TP, it is 260 pips. So when the price closes above the baseline, we have to make sure that the price is not 260, sorry, 200 and maybe 50 pips below, so up from the baseline. So this distance here is not supposed to be 200 and beyond 250 pips. So there is a time when the price closes above the baseline, but it is too far from the baseline. That is when we do not take that trade. Let us try to look for that scenario and see. Where can that scenario happen? These scenarios normally happen in gold. Exactly, beautiful here. So when you look here, right here, this was a perfect time to trade. For example, here when you look here, the candle closed above the baseline because right here it was on a downtrend, and then here it comes to give us an uptrend. So you can see that from the baseline, this is where this candle closed. It was not above the baseline, so waited for a different candle. This is the candle which crossed above the baseline, this big candle. Okay, so from here, where the price, that is the baseline, where the price has closed, the price you're going to enter from, you have to make sure that the distance here is at least 1 ATR at most. It shouldn't be beyond 1 ATR. Why? Because if it is beyond 1 ATR, it means that you have paid too much for that price. Okay. So when you click on this candle, I want to find out the ATR. It is supposed to be 155 pips. So you have to come and measure. Aren't they more than 155 pips? So that is what we want to find out. Okay. Control F. So we want to measure from here where our baseline is, from the baseline to the close price. Isn't it more than 150 pips? If it is more than 150 pips, of course we don't take that trade. But this is 140 pips. It means that we were free to take that trade. Okay. So for example, right here, once again, you can see that from the baseline to the close of this candle, it was 100 and 111. That's our like 102 pips, 112 pips. So if it's 112 pips, you have to make sure that how much is the current baseline of this candle, and it was 160 pips, so you can take that trade. Okay, let us look for a place where the price moved too far from the baseline. They are not so common scenarios, but we have to make sure that if it happens, of course, we don't take that trade. Just want to find out the place and see if it can help us. Okay. Where is that? Where can that happen? So we are looking for that to see that the price is not far from the baseline. For example, on this candle, for example, this big candle here, it is showing us that we are bearish, and then we want to measure that from the baseline. This is around here, up to down here where the price closed is 101.15. That's 115 pips, but the baseline, the ATR is supposed to be 150. So that one was okay. So I want to look for price where the price was far from the baseline so that we exclude such scenarios. So for example, when you look here, This is a beautiful place to look at. Okay, so right here the price was still below the baseline. Okay, and then following day the candle created a gap. Okay, and it closed above the baseline. Okay, so what happens is that the price is right here. This is where you're going to enter from, and this is where our baseline is. So what you're going to do is to measure that distance. Okay, so we are looking at that. So this is Control F. So from the baseline to where we are going to enter our trade from, it is 187 pips. But the current candle that we are going to use for entry is 141 pips by 1 ATR. So we don't use that trade. Reason being that the price is too far from the baseline. So if this is where the baseline is, and then you want to put your price here, the price is too far from the baseline. So we don't enter that trade because the price is far from the baseline. That is what we agreed on. So we say that when the price closes above the baseline, it's supposed to be within the 1 ATR range. So we're saying that this is where the baseline is, okay? And then this is where the price has closed from. This is where we're going to enter from. So from the point where you're going to enter to between that distance here, this distance here is supposed to be at least 1 ATR. And we've measured this and it has been almost 160 pips, but the current ATR of that candle was 140 pips. So it is far from our target by 20 pips. So what we do is to wait for a retracement. So for example, here we wouldn't have taken a trade, but we would have waited for the price to come back and get back into the ATR zone, for example, here, and then we take the trade from there. Okay. So we shall be looking at this more and more as we do backtesting together in different videos. Okay. Let us try to measure this and see. Okay. It will not work for us. This will not work for us. Those are rare scenarios to happen, but they do happen within the market. 180 pips. It's 200 pips. So 193 pips. So from the baseline. All right, this will work for us as a good example. What will work for us as a good example? We've seen the other one. Wanted us to get a second example, but it has gotten lost. So maybe when we get it on a different pair, we shall be able to use it. Or maybe when the baseline is different. Okay. So go to insert trend, moving average. Okay, what is okay? I'm trying to look out for that example. Okay, so for example here, you can see that the price, this is a baseline, and then the price has closed from here. That's 111 pips. So, but you're going to enter from here, that is 170 pips. It was still okay. It is still within the 180 zone. I want to see that level. Which one can we use? If it gets lost, please, I'll be sorry for you. Okay, let's try to look at this candle here. The 100 and that one is okay. These are rare scenarios to happen in the market, but if they do happen, of course, we have to avoid them. Let me see. So for example, there is this baseline, okay? So for example, there is this baseline. When you look at the chart, okay, this line, this green line here is our baseline, okay? And these blue lines, which are covering them, like the Bollinger Bands, are what we call the ATR bands, Okay, so the price is supposed to close above the baseline, for example here, but it shouldn't be above these blue lines. Okay, so they are used for measuring the ATR. So if we go back to history, okay, let's try to go back into history and see where the price. So for example here, the price is above the baseline, okay, but it is within the ATR bands. It is not above the ATR band, so you can take that trade. We can see that here the price closed above the baseline, but it's still closed within the ATR band, and then you can still take that trade. I'm looking for a scenario where the price closes above the baseline and it also cuts through the band. So for example, when you look here, this is beautiful for us to look. So when you look here, the price had not closed below the baseline. So by the candle we waited for to close the baseline, it came and closed below the baseline, and then it also closed below the ATR band. So this candle closes far from the ATR. So we want this price to close, at least to come and close within, for example, like that. It is within the ATR bands, these blue lines, okay? So if the price closes beyond the blue lines, it is far from for us to trade. So for example, we had to enter a trade from here, and maybe the stop loss is going to be here, but this is too far from the baseline, so we cannot enter from here. So the price is too far. So maybe we would have entered from around here if this kind of closed within the ATR zone. So but we had to take a trade from here. So what we do is that we wait for the price to come and reclose. So here you don't trade, wait for the price to come and close back into the ATR zone, and then wait for bearish candle. So this would have been your entry. Okay, maybe you can look for another example, make it more clear. So the same scenario happens here. Okay, you can see that we say these blue lines are the ATR bands. If the price closes the ATR bands, we don't do anything. So here we are waiting for the candle to close below the baseline, but it didn't. And then right here, the price closed below the baseline. But what happens is that the price is also closing out of the ATR zone. So we don't trade. We wait for the price to close within the ATR zone. So for example, here, and then wait for bearish candle. This was supposed to be our entry candle, and then we wait for that move down. So for example, right here again, you can see that this candle, that the price has closed out of the ATR band right here. So we don't take that trade. Okay. So I think this is enough for the baseline. I think you can try to make any sense. In case you've not understood the things very clearly, please let me know, and then I'll be able to come and make them more clear for you in person. Okay. So that is how it works. Okay, that is how it works. So that's how the baseline is. So you have to make sure that you look for baseline which excludes the market fluctuation. So for example, here this was a buy candle right here. So we had to wait for the price. This price has closed the baseline, yes, because this is a baseline, but it has also closed above the ATR band. So this means that the price is too far from what we can buy from. It is priced for us to buy. So here we don't take this trade, and that would have saved you this losing trade. Okay, so thank you so much for watching this video. That is all about the baseline. So you go out and test different baselines you can use on the charts, and then be able to see. So the other thing I want you to note is that, before I close, I'm sorry, is that you can also use moving average crosses as your baseline. So for example, Control I. I don't know why this is not working. So what I'm saying is that you can also use moving average crosses as your baseline. So every time you see that the moving average have crossed each other, so you go for a buy. For example, right here, the first moving average is above the slow moving average. So that was a good time to buy, though it had this market fluctuation. So you can see that you can also use, for example, right here, when the moving average cross each other, they can also be used as a baseline. Okay. So for example, here, it's a time to buy, and then you wait up for that long. So you can see that it has given us a very big window without giving us a new signal. So that makes that good baseline. So for example, you can use moving average. For example, the 6 EMA and 18 EMA. When the 6 closes above the 18, it is a buy. So you can go and watch videos about moving averages. So you can also try to use moving averages as your baselines. So they can also help you to, you can exclude so many market fluctuations. So for example, right here, you avoided this market fluctuation. It didn't give us a signal. And then it came to give us a signal right down here. So it means that we're going to go short from there or around there if the exit indicator doesn't tell us to exit. So that is how you can also using moving average crosses. You can put two moving averages, a fast moving averages and a slow moving average, so that every time the fast closes below the slow moving average, that is a sell signal, and when the fast closes above the slow moving average, that's a buy signal. So for example here, fast below the slow, that is a sell, then the fast above, that is a buy order. So you can use moving averages as moving average crosses as your baseline. Okay, so thank you so much for watching this video. Don't forget to subscribe to the channel if you've not yet done it. My name is Utom Jordan, and I will see you in the next video. Bye bye.